All right, folks, welcome back. This is our midweek review for the ICT mentorship. So we are looking at the economic calendar for tomorrow. This is Thursday's calendar, 3:30 a.m. high impact PMI number for Euro, and then tomorrow, wow, between 7 o'clock and 8:30, we have some real fireworks for Forex, GBP, and Euro. So we have monetary policy summary and official bank rate votes for GBP, and then the monetary policy statement and main refinancing rate for Euro, and an ECB press conference at 8:30. So lots and lots of volatility. So today we saw the FOMC effect at 2 o'clock, and I had a member ask from 2020 enrollment, how did I know that 2 o'clock news would be the most impactful? We've been talking about FOMC throughout the years in this mentorship, and it's always going to be potentially volatile. And today was a testimony of that. So that's why I always warn you when FOMC is occurring to be careful, because it could be a lot of both sides of the marketplace, the big whipsaw moves, and you can get hurt if you don't know what you're doing. All right, here is the dollar index. I promise I'm going to go through this briefly tonight, and I gave you a long video last night, so I said what I said. I didn't get any kind of real negative feedback. I got a lot of positive feedback. There's no need to send me any emails about last night's video because it speaks for itself. All right, so the dollar index daily chart. So above this high here, we had that weekly imbalance, which is not going to be shown here, but I'm still looking at that as possibly an upside draw. We may get a reaction off of the news drivers that come out tomorrow for pound and euro. So that might be just today seeing FOMC run above the rejection block here, which is interesting because today's lecture is on the rejection block. We had yesterday's open, it trades down into the order block here, starts to expand in the direction we've been looking for. So again, while we have yet to make a higher high here, today was just short of that. The directional bias for the week has been on track. It's bullish dollar, bearish foreign currency. The red level is the rejection block on the daily chart. So you can see we had a run up in that on FOMC, sweep the rejection block, and then gave up the ghost. I have yet to abandon the bullishness on dollar index. I'm staying with the higher time frame order flow. I'm not using one day as a decider whether or not the market is reversed, because it's going against the higher time frame order flow. So we have to demand a lot more than just simply one day. Came down, rebalanced all the buy side and balance, sell side inefficiency here. Interesting how it traded into that. We'll see what we get in regards to overnight leading into the New York session. Just be mindful that tomorrow could literally be an Al-Qaeda situation where one bomb goes off, everybody runs away from that first bomb into a larger bomb waiting for them, and then more casualties. Okay, so basically both sides of the marketplace can get whipsawed as a result of what's in the economic calendar tomorrow. And here's the 15-minute time frame again, running up into the rejection block on the daily chart, and then coming lower. Breaker, high, low, higher high, down close candle. We trade up into that, then sells off down into an order block. Imbalance closed in as well. So again, even though this looks very concerning for the bulls, I'm not convinced based on, like I said, one single day, especially with what we have in the economic calendar for tomorrow. Anything can happen. They could rip this thing straight to the moon, okay, and roll right over top this high, and it'd be like nothing. Or obviously it could go lower. What am I saying? Wait until the economic news comes out tomorrow, post 8:30 a.m. Look for imbalances, look for liquidity, then engage with your tape reading. Then you can do a demo trade, but not before, okay? Because you're asking to get clipped, because the short-term volatility and knee-jerk reactions that would be seen as a result of whatever they're going to release in terms of their monetary policy. And no one knows what that's going to be. And even if you did, the central banks can do what would be expected in the marketplace and do the opposite. Okay, send the currency the other direction. All right, Eurodollar daily chart. Okay, we able to wipe out the short-term low here, then came off of that. We dug into basically the mean threshold of the bullish order block in here, closed in the entire remaining balance of this imbalance. There, hit it, and then came right back inside the range again. I'm not convinced. Okay, I'm not convinced that this has created a low and that it's going to go higher. I'm willing to be wrong. It's fine, but I'd rather die on this hill a few times, okay, where going against the higher time frame order flow is problematic. And the few times that you can lose or miss certain moves, when it does reverse, it's not worth losing your mind over, because there's a lot of times you'll want to try to pick the bottom or pick the top in higher time frame moves and order flow, and it's just painful. It's needless suffering. So to avoid that, you just stick with the higher time frame order flow. In short, I'm looking to see if tomorrow's news can drive euro lower. And again, I'm not trying to pick a bottom. Hourly chart, euro dollar. Here's yesterday's business, as you saw. And we had an imbalance in here. We wiped out the low that was formed on the 7th, expanded well beyond where I was outlining the market maker sell model. And I'll cover what caused all this too, in case you were wondering. It's part of the teaching today with this last portion of the video, because I didn't go into detail what gave me the framework for this, but I'm going to do it today because I knew I'd cover the teaching topic that we did today, or would be doing today rather. I apologize when I'm driving you nuts with the cursor going around, but for whatever reason, some days this software program I use to record with, it hides the mouse, and I'm not sure why it does it, but it gets on my nerves, so I have to keep moving around real quick to find out where it's at. All right, so we whipped down through, took sell side liquidity out over here on this low. Nice drop for liquidity, and then rammed it right up into the rebalance over here for the city. So sell side imbalance, buy side inefficiency has been rebalanced. And like I said, I'm not looking at this as a one event turns us around and reverses the entire thing. I don't see that. Now, could we run up here, clear out these relative equal highs there, and then go lower? Sure, that can happen. I mean, we're only talking about a penny move. 100 pips is a penny. That's nothing, especially on high impact news like we're expecting tomorrow. Man, it can make real short order of a penny move with what we have coming in the New York session. And just as easily, and conversely, we could see this relative equal high be broken, and it could run a penny higher above that. In other words, 100 pips above that. That's how much volatility can come in based on whatever they release in terms of what they expect to do with monetary policy and what the central banks do. Again, these are the moments. This is one of those moments where you write down in your journal in case you weren't paying attention. So I'll give you a minute to grab your pen. These moments in the economic calendar, this is where manual intervention can come in. Expect unexpected. Expect crazy whipsaw price action moves that really won't make sense to the average trader. And that's why you let that initial shock come into the marketplace, because it's meant to disrupt sentiment. It's meant to induce trust in an existing run. It's immediately as the news hits the market, that first run, that typically is the wrong one, much like we saw today here on FOMC. While it was tradable, it ran below that low here. Then it went the other direction. This is classic non-farm payroll classic non-farm payroll. We don't see it so much anymore like this, but that's how non-farm payroll used to work. The initial run after the employment numbers would come out, it would give you an initial move, and then usually that was like a Judas swing, and then you want to fade that and go the opposite direction. Not all the time, but majority of the time that's how it was. And FOMC tends to create those types of scenarios. Now, I find it interesting that it happened like this ahead of the monetary policy that's coming out for Euro tomorrow. Isn't it interesting how the market dove down, broke this, what would be seen as support, and then rejected it? So now, everyone sees this and says, well, it's probably bullish now. And this was a strong reaction at an old low. This is rejection. It's got like a big long tail on the bottom of it. And Steve Nielsen says that's usually a good sign for buyers. And hey, we got resistance up here. So let's see if it can get up to that. And if it breaks resistance, what is that going to mean to them as a retail trader? Resistance is broken. And then if it comes back down to that, they'll want to buy it. So what that's going to do is create, in my mind, buyers that want to buy above these relative equal highs. So that way smart money could be, sellers to that, and then run it lower. That's what I'm watching to see what could happen in that regard. I'm not convinced that would happen or will likely happen, but that's a scenario I'm watching to see if it will unfold. I'm not trying to do anything or forecast anything with a surety, because I want to see what they do, and they being the central banks do, when the monetary policy announcements hit the market, both in British pound and in the euro. About 15 to 30 minutes after it hits the market, that initial shock wave, what is left in the marketplace for either liquidity, imbalance, and what narrative I see in the price action at that time, that would be the indication for me to decide whether or not I want to be engaging bullish or bearish, okay, based on the initial Judas, because that's how I'm interpreting price, or anticipating rather, what may be given to us when price is delivered after those news drivers hit the marketplace. 15-minute time frame on euro. Here's the market maker sell model. Everything as I mentioned yesterday. We broke down below the low, dug in, and then today another washout. Cleared out the old low. Rejected that, sent it back up into the imbalance, and now this bearish order block. Beautifully done. Now, again, this looks very compelling to lower time frame traders that see things like this. They think, okay, yeah, we made the bottom. Not with something like we got tomorrow in the economic counter. How can you trust that? Now, it can really take out this high and keep on running higher tomorrow based on the fuel that's being utilized in the sentiment, disruption, manipulation, and then the algorithmic delivery after the fact, after the news hits the marketplace. Then the algorithms will kick in. So what am I saying? Tomorrow, 7 o'clock to 8:30, we are likely to see 2 manual interventions. That means man at the central bank level will manipulate price. That's my suspicion. Okay, I'm making that allegation that that's what's likely to occur. And I think that's going to be the initial false move. I'm waiting to see what that is, because I don't know how they're going to use it. Well, that's why I tell everyone, just sit on your hands and wait until that initial shock wave hits the marketplace, then go in. Okay, we don't want to fall victim to a Judas. We don't want to see something in the market that isn't really there and be induced to take something that would be a false setup and then watch it rip against us, in stunning fashion, because that's usually what happens. All right, here is the pound dollar daily chart. And again, we're just stuck inside this range here. We're going to see something tomorrow. If it goes higher initially, I think it's going higher to go back down and take out these lows. And that would be bullish for dollar index. That's kind of like what I'm favoring. I want to see something like that. All right, and again, just range bound. And I mentioned that this pair would act like this, have a modest, bearish tone to it, but likely to continue going sideways with no real clear idea what it wants to do. Go back and listen to the video or videos for the last week or two, and you'll hear there is no real interest in this particular pair for me because it has no PD arrays that line up with a narrative. Like there's nothing here to frame together except for it's range bound. And I guess if you put a overbought or sold indicator like Williams percent R, like 10 period or 12 period percent R, and put it on an hourly chart like this, every time it's overbought, you could expect it to sell off. And if it becomes oversold, you cover back and forth, back and forth. That was the that was the thing that I believed that it was. That's all you had to do as a trader when I first started using indicators on Metastock, which was a platform I used back in the early 90s, 1993. Well, in this instance, I'm not interested at all trading pound. I'm not interested at all. Even though it's got big news coming out tomorrow, I still won't touch this one. So what I'm watching to see is if the euro gives me something to work with, because I'd rather trade that one than pound. I have no real clear objective on what pound would be reaching for, and that's the number one thing that we look for that frames an idea. Like you have to know where the draw is. Where's the market likely to go? Because if you skip over that part, this is one of those moments you write down in your journal too. Before you ever consider entering a demo trade, okay, before you even consider it, before you even consider paper trading it, before you ever consider reading the tape and studying what it's doing, you absolutely must have a understanding of where the likely draw on liquidity is. Where's the market likely going to? Is it going up to a specific level or is it going down to a specific level? You may not get that level eventually hit, but what is framing the idea? It can't be on something on a lower time frame. You have to have something on a higher time frame, daily or 4 hour, to give you the proper context. That gives you the initial clues to submit yourself to a bias. That daily bias must be framed on a higher time frame, not something lower time frame. And 4 hour is the lowest that I would consider for framing bias. Then daily. But then with that, you have to ring in, what is the weekly chart likely to do? Is the weekly chart this particular week that you're trading, or if it's during the weekend and it's the week you're about to trade, is that weekly range, that one single weekly candle, is it likely to expand higher or is it likely to expand lower? And by blending those two things together, you have high probability bias. Doesn't mean it's perfect, doesn't mean it's going to be exactly like you think it's going to be, but that's how you go in and you stick with that side of the marketplace. I'm so astonished to see so many people in this mentorship still sending me emails and saying, I'm trying to do this in the market and it's not working and I'm struggling. And it's against the ideas I give you in terms of bias in these commentaries. I don't know what I have to do that I haven't already done and spoken many times for the newest of the students. If you try to go against what I'm outlining as my personal bias, where I think the market's going, this is not ego, it's experience. You are arm wrestling almost 30 years of private interpretation of price. My understanding is not going to be equal to yours. So if I have almost 30 years reading price, how can you argue and say you're struggling because of something other than you not submitting to what I'm sharing with every one of you? You are all getting the same commentary. You're getting the same thing. I'm not splitting my group and this half of the group gets me saying it's going up and this half of the group says it's going down. You're getting the same thing. I've been calling dollar higher. Submit to that. Don't be afraid if I get it wrong. Because if I get it wrong, that's fine. That's either going to tell me Okay, I have to change my bias and then we'll go the other direction. Or I tell you, stand aside and don't do anything. Wait for more information. That's what you're going to be doing in your own when you don't have me beside you. So submit to that. It's not weakness. Okay? You're not blindly following me. You're using the logic I'm trying to teach. So I'm leaning on the concepts and the theory. So you should trust that. You're not trusting me. You're trusting the concepts used effectively at the proper time, the right way. Okay, and that way you learn by experience. I'm walking you forward daily and weekly with these concepts and pointing to where the market should draw to. So bottom line is don't arm wrestle me. Okay, it's frustrating for me because there's no real nice way to answer that when I get emails saying, yeah, I see this in the chart, but you keep saying that. Well, the thing I'm talking about in the chart tends to be delivered. And the thing that you're emailing me about is failing. So the logic goes back to, okay, I'm trying to do something that's opposite to what my teacher's telling me I should be focusing on. There's your sign. Okay. I know it might not feel like, it's your issue, but I'm politely reminding you that that is your issue. And I still have members in 2016 that still want to do that. And they still will periodically send emails, hey, I'm reaching out to you again. And I remind them as politely as I can, why are you going against the commentary's bias and framework? Like you're literally trying to swim upstream with an anvil tied to your ankle. Like you're literally trying to do something that would require fate, luck. I mean, it doesn't make sense. So obviously I'm trying to be lighthearted about it because there's really no way of saying other than you're wrecking yourself by doing this. Okay, so you have to just get in sync with what I'm trying to tell you. I mean, it's here for you to see. The track record is plain as day. Most of the time, the things I'm telling are happening. So stick to that narrative. It will train you to trust the concept. Because here's the rub. If you don't do that, how on earth are you going to train yourself to believe these concepts are going to be effective for you? Because you aren't properly using them. You're not using them in the proper context, but you're sending me an email saying that I can't find profitability. I can't find consistency because this is failing. I see this in the chart while you're talking about that. Well, that is what I want you to be focusing on, not what you are trying to find with the infancy that you have in terms of experience. I'm not trying to say that you don't have something of interest in the chart that may be tugging at you. But if you're so new, and you even admit in your email to me that you're doing the opposite of what I'm coaching all of you to look at and focus on, because I'm like the spotter. Okay, you're a sniper in training. I'm your spotter. I'm taking your attention to a specific place on a higher time frame chart. Keep looking that way downrange. And everything you do, keep firing towards that direction. Even if you mess up along the way here and there, you still are doing it the right way. You're not shooting it the opposite direction. You'll never hit the target that way. All right, 15-minute time frame. I said I was going to do a very short video. It never works out. I just got to stop saying that. Just do the video and then say, okay, there it is. All right, so 15-minute time frame, pound dollar. Buy side liquidity taken here. And nothing in here I like. It does rebalance there. Okay, it's fine. But this sell-off here, you got to look at this on a 5-minute chart, which I don't have, and I'll leave that for your own study. The 15-minute time frame doesn't really do too much for me in terms of providing any context. And I've already stated that I wouldn't touch this particular pair. Ran out sell side here. So what did it do? It took buy side here and then took sell side here. Classic FOMC. That's classic also, like I mentioned earlier, old non-farm payroll price action, where it takes both sides of the marketplace and then leaves you thinking it's really bullish, and then we'll see what we get tomorrow. I'm thinking, nothing here has turned around yet, and I'm ready to fall on that sword tomorrow and be wrong. And that's okay, because that will give us, again, another week or two, maybe even a month of directional bias framework to look for the opposite direction. But right now, I'm not I'm not convinced that we've made the low yet. All right, we finally made it here. The ICT bearish rejection block. All right, so yesterday I gave you the framework for this being a market maker sell model. And I mentioned during the recording, the first half of the recording yesterday, I mentioned how there was a potential order block in here and we wanted to see that fail. In other words, a bullish order block in yesterday's video. If it goes down too deep in that, that's a confirmation that we have, in fact, worked off of this rejection block. Okay, so this is yesterday's framework, is what I was looking at, that I did not include because I wanted to have a teaching today on this very topic, rejection blocks. Now, when the market had ran up into this level here, you, if you're new, look at that as relative equal highs, and the market was retracing down here, and I got a lot of folks asking, how on earth did I say in that video with all the lipsticks, all the things drawn out, it wasn't like just me talking about it, because I can do audio dubs over old moves and make it seem like, hey, wow, he said that this is what's going to happen. And at the time, I may not have thought that. That's the reason why I type it out and do annotations inside a Telegram. Because if it's typed out, there's no hiding that. There's no blocks covering up anything. You know, the annotations stay in the chart the whole time. It's not like a little flash of something where, you know, they can put something in the chart and try to do what I do, but then the comments don't stay, their annotations don't stay in their chart. They just like pop up and they go away because they're putting in multiple things if they're recording. And the ones that work out best, that's the ones they'll keep in the recording. Because if you speed up something really fast, you won't know that that comment wasn't in there long enough to prove that they had another expectation, in other words. So when I did the annotations, they stayed in the chart for the duration. Like, they did not come out. So before the move even occurred, I had already framed out this is the best case scenario where the draw on liquidity is, and I wanted to see it trade up into this, sell off, and if it hit here, this would act as resistance and sell off towards that level down there, and it'd be a market maker sell model. The framework for all of that was this rejection block right there. Okay, so we traded up into that level and it went down into this level here, and some of you may have looked at this imbalance and said, okay, it's rebalancing there, and now it's going to run the relative equal highs. That is not necessary if you're looking at time of day and the economic calendar. So at 8:30 yesterday, when we had PPI number for the US, we had a high impact number, and we had already ran out rejection block there, and we dug in. Then I incorporated what? The bullish order block failing. I didn't want to buy it. I wanted to see it fail. And when that failure in the order block happened, that confirmed to me that we had the rejection block turning the market here. And this, in fact, was a market maker sell model that I wanted to be in this particular order flow and not try to expect it to go higher. And it gets in sync with what we were looking for higher dollar. So all of those things and factors became perfect. All the stars aligned for that. And that was the whole framework here. Now, the key takeaway and what I want to talk about with the rejection blocks tonight, and I promise there isn't a whole lot to it in addition to what I've already taught you in the lecture series that I did in the core commentaries, or core content, not commentaries. But once you have a higher time frame rejection block here, once you have that, you got to go down to a lower time frame. And this chart here, we can drop down into a 5-minute chart and then see all the things that you watched me do yesterday with calling the outline move and how it delivered. So a higher time frame rejection block, then use the narrative and bias to get in sync with a setup. Or in other words, a rejection block on a higher time frame is a catalyst. It's not a timing tool. It's just, okay, we have ran a rejection block, now drop down to a lower time frame. For instance, if this is an hourly chart, once we have the rejection block and then we're standing in front of a news driver like we had yesterday at 8:30 in the morning, the dollar PPI number, I wanted to see it prove to me, let the algorithm speak through the chart like I'm teaching you to interpret it. Not that it's doing so much of that all the time, but the way I teach you price action, that's what I'm trying to convey to you. These languages that I teach with PD arrays with bias will give you the tapestry to work within price action to see setups forming, when to engage, what to anticipate, why should it be doing this at what time, and then how should it deliver? Should it deliver, lethargically, or should it run aggressively? Second stage distribution, that's when speed and magnitude comes in, and this is what you get. It ran right down into the sell side here and continued over into a secondary run. Conversely, for the ICT bullish rejection block, we have a low, the lowest down close here, and we trade down to that. At that very moment, okay, at that moment, as soon as we sweep below that, again, assuming this is an hourly chart, as soon as you get the rejection block and it moves away from that, and say the bias is calling for this to go higher, whatever market this would be, okay, if it's calling for it to be higher and you have a rejection block, and this is hourly, you drop down to a lower time frame. It could be a 15-minute time frame, it could be a 5-minute chart, okay, but you're going to be looking for something after this low forms. That would be a bullish discount array. And what does that look like? Well, here's a 5-minute chart after it sweeps the rejection block. It doesn't take out the old low. This is the rejection block. It trades down into that, and then what does it do? It runs up, breaks market structure. Now it's bullish on the lower time frame after a higher time frame rejection block. What does it leave here? Buy side imbalance, sell side inefficiency. Order block. Trades down to that, rallies, comes back in again, order block, rallies once more, order block, supports it here. So now down close candles are doing what with price? Supporting it. You have multiple entry points in here to get in sync after the rejection block. Okay, so rejection blocks can be traded right into them if you're really strong with your analysis. In other words, you know that we're running out liquidity. It's not going to take out an old low because this market might be diverging when another SMT related correlation is saying that it went lower on this run here. This one's failing to go down. Well, wouldn't that be SMT? Right. So this is the pair or market you would use that you anticipate not seeing the low taken out because it's diverging bullishly when a correlated market would be going lower. How do you trust when to get in the marketplace and it's not going to take out the low? SMT. So there's a time and place for everything, but you have to have experience looking at it, studying it with that context. And once you have that, you can trade that rejection block right into it and buy it. But while you're learning to trust it and use it, you can wait for it to react down there. And then once it creates that run higher, then go in, start looking for your discount arrays. And then there you go. And then the down close candles confirm order flow is bullish. Every down close candle is support and price. This one here has that little tail, lines up right there, and it rallies. This down close candle here, it drops down into that, and it rallies. Okay, order flow is bullish. So you can take trades on this 5-minute chart framed on the hourly chart rejection block that's bullish. Okay, main takeaways again are: how do you know when the low is not going to take out the low that was made prior to it and just hit the rejection block? You want to be measuring it against a correlated market for SMT purposes. So preferably the correlated market, say for instance that this is, say, and it's not, but let's say this is euro. Okay, and as euro was making this low here, now on the 5-minute chart it shows a lower low, but remember, before I did this, this was the chart here on the higher time frame. Okay, so let's assume this is an hourly euro. It's not the euro, but let's just say it is. This low and then the higher low that's forming here, at the same time, dollar index may be making a higher high when the euro is making a higher low. That's diverging. Okay, in other words, the euro should have went lower than this low when the dollar itself makes, at this same time in the chart for euro here, it should be forming a higher high in dollar. That's SMT. So your smart money technique of looking for divergence between correlated pairs or inversely correlated pair versus dollar. Euro is going to be the opposite of dollar. So if euro is making a failed lower low, it doesn't go lower than this, in a symmetrical market, dollar should be making a failed higher high. But if the dollar is making a higher high right here, when the euro isn't, then you look at the rejection block. That's your catalyst. That would be the entry for me for a rejection block. I would be trading it right when it gets into that price right there. I'd hit it right there and trust the fact that we won't take out that low because it's showing divergence in the SMT between the dollar. Okay, or this could be the euro and say the pound is going lower here and then pound went lower than its low here, respectively, in terms of time, where euro isn't. That means for a correlated pair SMT divergence, euro is relatively stronger. I can buy the rejection block, which is that lowest down close price. Buy it right there. And then go into the 5-minute chart, wait for this move here, pyramid, buy more of it here, wait for the run here, go in here, buy more, pyramid, buy 10 lots here, buy 8 lots here, buy on this in here, 4 lots, and in here, 2 more lots, and then let it run. And that's how I would pyramid, that's how I would build in a position, the largest being the initial, because that supports all the subordinate smaller ones. And it's not a inverted pyramid, which is not stable. The pyramid with the widest base at the bottom is how you properly pyramid. Improperly is how I learned it from Ken Roberts, which is buy 1, then try to do 2, and then 2 to 4, and then 4 to 8, and 8 to 16, and 32, and then you get wiped out when there's a small little move that pulls against you. This way, if you have your largest position down here, and you break the high, you have market structure in favor for higher prices. And then you watch how all the bullish order blocks provide support, and you know order flow is bullish. And you can build in a position and pyramid that up. And that's how you see me run these demo accounts up. That's all I'm doing. I'm just doing it with the maximum that I can do down here at the initial entry, 4.5%. Sometimes I did 5% if I felt really strong about the position. And then just added it up again each time. Boom, 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 boom. 4.5%. Do another 4.5% here. Do another 4.5% here. Another 4.5% here. And it doesn't take long, folks. That's why it quickly runs up. And everybody thinks it's rented MT4 servers, and it's not. It's just literally parlaying and building in positions with the same measure of risk on each new trade. So if the new trade gets entered, like if I buy the rejection block here and then I buy the bullish order block in here and I'm risking 5%, or I'm sorry, 4% in here, I get tagged on 4%, but I still have the balance down here from buying the rejection block. So it kind of offsets that loss. You see what I'm saying? And it's also half the position that I put on this mouse. I tell you, it drives me nuts. It's half the position size I put here. So even if I get stopped down here, this position still is profitable and covers this. You understand what I'm saying? So let's say I take a 4% loss on the position size that I used here as an entry. Well, I have 4% risk using this entry from down here, and I have all of the space from wherever my stop would be on this entry to where I entered down here. So each time I'm doing it with smaller position sizes, but I'm building in the same measure of risk. But I have all the previous trade behind me supporting it. That is one of the elements to my interpretation and utilization of Ralph Vince's Optimal F. And I build that in. It's aggressive. It's really, really aggressive. And if you're wrong in your analysis, it will really burn you. Like, it will sting you bad. And you have to have a way to use, which is what I gave even on YouTube. You have to split your risk. So if you take a loss and you say you used 4.5% and you got burned on that, you got to trade with 2 1/4%. And if you burn on that, then you got to trade that in half. And you keep doing that until you make 50% of the previous largest, or not previous largest, but the previous larger risk that you took leveraged. And once you make that back, then you're allowed to go back up to the previous leverage that you used. And if you lose again, you got to go down to, obviously, to the minimum, whatever your minimum would be for risk. And you stay there to ground you psychologically and emotionally. So that way you don't lose your mind and completely blow out the account. Because drawdown will literally bury you if you don't control yourself. But when you're on side and you're dialed in, and there's a few times a year when it's easy to get on side and really milk these positions and build them up. When that happens and you're able to do this, and I'm not teaching this part today to say, hey, now look, now go out there and do this with your demo account, because you don't even know what you're doing yet. Okay, but I'm answering the questions that come to me. Hey, can you talk about how you build these accounts up and run them up really fast? I just explained it to you. Okay, I'm teaching you how to use these concepts that's in the core content. I'm teaching you how to use aggressive optimal F strategies. Okay, and knowing what I just told you, some of you, hopefully, I'm going to stop you from doing any damage to your demo account. But listen to me. Just because you heard me explain it here and you can see it and understand it in this chart does not mean you know how to do it now. I'm going to say that once more. Just because I explained it to you and you're smiling and you're excited and you're thinking, yes, I am going out there and getting an FTMO account and I'm going to do don't. Just relax. Okay, because you have a lot of learning to do before you can see this coming and then build all that position in. Now, I have videos of me doing what I just explained on YouTube. You know, the ones I'm playing music and I'm pyramiding it up and doing all that stuff. Okay, that's exactly what I did in that video that I've never, ever taught. Now, I just taught it. Okay. This is how you win competitions. This is how you win contests. This is how you rip trolls' hearts out and squeeze the blood out of them right in their face before they drop and hit the floor. Okay? But you have to know how to do it. You have to be able to do all the things, not just this. Because showing it like this is conceptual. Watching me actually do it, not with a rented MT4 server, because those orders were being entered. Those new orders were being placed. The new stops were putting in. Everything was being managed. It's on YouTube. Those videos, it's still there. I didn't create something and cherry pick it. But the logic that I was using in that video is the same thing here, just reversed. I was going short in the market. You saw me doing the pyramiding in the video. This would be the opposite, where you would build in the position and the framework would be on the rejection block. Wow. Yeah, how about that? And they say there's no proof. Rented MT4 servers. Listen, I know enough about it because I've listened to everybody else talk about them. Rented MT4 servers implies that you go in and enter a trade after the market has moved. You do not see me doing that with MT4 examples. You see me entering the trade on the screen and you see it popping up right there after I enter it in the screen. Like you can see it. Then you watch me put new trades in the same way. That's not an MT4 rented server, okay? It's so nonsensical, okay, to believe the nonsense that these people spew out their face and hope that, you know, keep throwing crap against the wall and see what sticks, and there it is. But the people that are really paying attention, that are really trying to learn, they can see past all that stuff because it's like, okay, that's not what he did. That's not what I was doing. I'm entering, I'm executing. And here's where you're learning it. You're learning exactly what I'm doing. I didn't promise that to YouTube audience. I promised it to you here. I told you would learn aggressive money management and competition style trading. This is it. And I just showed it just with one PD array. Just one. Now, each PD array could give you this same framework What constitutes this market going higher here? The rejection block and the logic that maybe SMT divergence framed with this pair or market expected to not make a lower low. So it's going to go higher. Wait until it breaks market structure. It does there. And then what happens? Wait for it to come back down to an order block and fill in the imbalance here. What are you expecting? You don't expect that low to be taken now because the what? Rejection block has already shown you that your SMT divergence, which I'm not showing here, but I'm telling you that's what would be the framework, the logic behind the scenes, the underpinnings of the marketplace. This low should not be traded beyond, and it should just start just going higher. So that high break in here, that's a market structure break. So when it trades back down into the order block, you've watched me do this. You watched me do it many times in the mentorship where I'm recording myself, giving the annotations, typing in, here's what's going to happen. It's going to react here, starts going to building up. It's going to do this. I'm drawing lines where the order blocks are, and it goes right down and kisses that level and it starts to go higher. Folks, you've watched that. You've witnessed this many, many times. What do you do with that information? Well, if you want to win Robin's Cup, if you want to win, Joe Schmo's tavern in the back, trading contest, and you really want to get into a competition and not talk about how you supposedly had a competition with people that don't even know who you are. You want to do it legitimately. You can do it like this and literally rip the doors off of their Buick. Okay, they won't be able to compete, but you have to know what you're doing. Okay, and by having these weapons in your arsenal, they're high-end weapons. They're weapons of mass destruction. And that means if you don't know how to handle them properly, they will blow you up. So you have to be very, very versed in everything I'm teaching here. Do not be in a rush to go into your trading and try to do all these types of things. I have lots more to talk about with this and teach that type of thing. But you all have to spend time as charter for a little while in the lessons that I haven't taught yet. And as we get closer to the next fall, okay, in the forum, I'll outline some things and some details on how you can go in using Optimal F the way I interpret it. Okay, because I don't do it exactly like Ralph Vince outlines it, and I'm not fully bore going head on like Larry Williams, where he's trying to just do the maximum position size he can do all the time. I think that's asking for suicide, and that was the number one reason why he kept getting hurt. And if you can Google his broker statements. They're on the internet. And you can literally see where he got in at every one of his trades and the size of his trades. The recipe, okay, this is one of those moments where I tuck something in a video. You only have to do 12.5% a week. Consistently every single week. And you will blow Larry Williams' record away. If you look at what Larry Williams was doing, he was just betting heavy. Okay? If you do 12.5%, you're going to be over 60% net return on the month. Now, 12.5% a week, you might look at that as thinking, man, that's like, I can't do that. Well, then you have to split it over 5 trading days and say, okay, if I get one setup that pays me, I don't know, 10, 12 pips, you can do that on a 1-minute chart. And you try to just get that 12.5% divided by 5. And that's your daily objective. And you do that. Now, here's the thing. If you're going to be in competition, you do it with the London session and the New York session. Because you have days where you're going to miss a trade, you're going to get it wrong, but you have to be systematic about it. If you do that, once you hit your 12%, even if you have extra days left in the week, it does not matter. You stop at 12.5%. The next week, you do the same thing. By doing the session in London and the session in New York, and you're trying to get 10 to 12 pips, like, that's easy. Like, that's really, really easy to do in any pair, in any market. If you're trading indices, man, like, you don't need that many handles. Like, it's so easy to find setups that offer you 10 to 15 full handles or 10 pips or 12 pips or 15 pips in Forex. If you're trading futures, it's handles. And if you work towards 12.5% each week, you will rip the wheels right off of Larry Williams' record. And you don't have to be in there trying to get these grand slam home run trades like he was trying to do with his trading. And you don't need to go full bore with the risk. Like he was putting on huge positions, enormous leverage. You don't need to do it that way either. He suffered in the 1987 crash, which was really not that big of a deal if you compare to today's volatility. But he was at $2.2 million. And he got hurt, and it fell down to $700,000. And by the end of the year, he traded that $700,000 back to $1.2 million, and he won the Robbins contest in 1987. But his huge drawdowns was attributed to his huge positions, and they were really, really big leverage. And you can do it that way, but it takes a lot of luck to be on your side to do that. And that's why his losses and his drawdowns were really horrific. Like they were like, I don't know if I can stomach that. And I've had some really cowboy moments early on in the 90s, but to trade like that, I don't think I could stomach that. And he admits that he wasn't a good person to be around during that year. He was stressed out. And I can see why. It's a lot of yo-yoing. But trading like this, using higher time frame setups, not trading like he would put in an order at the open and hold for the day and maybe the next day or the next day after that. That was his trading style. Because he's kind of hoping he's going to get the daily range. You don't need the full daily range. I'm teaching you high frequency trading. I'm teaching you that through a demo account. And you see that pattern repeating over and over and over again. So the setups that he's waiting for is on a daily chart. So the intervals for a new setup is limited to, at best, 5 a week for any one particular asset class. Now, don't get me wrong. I'm really oversimplifying how he was trading. I'm just giving you like a broad brush, comparison. Compare that way of trading competitively. Okay, because say some of you want to do the Robbins Cup, some of you want to do, Olympic style things, and that's great. I would be so proud to see any of you just place, on the leaderboard. Hey man, I already got a student. Up there. He won the stock division, and it's not a lot of percentage, but hey, guess what? I have a student up there, Mr. Garner. So he won the stock division, and you have nothing but opportunity on these lower time frames. And here's the beautiful thing with that lower time frame. If you control yourself and your frequency of trade, you don't overtrade, you specifically go in looking for setups that offer you high probability and runs to low resistance liquidity runs. Remember, this is supposed to be a short video. I get caught up in these things. I can't help it. But let's say you miss an opportunity and you're trading short-term trading opportunities like Mr. Williams was doing in 1987. Man, you got to wait. Who knows how long until the new setup forms? It might be nothing the rest of this week. Now, take this to a intraday chart where you're working inside of an hourly chart, maybe a 15-minute time frame market structure, and you're aiming for 10 to 15 pips or 10 to 15 handles in indices. The volatility we had today was nothing like that when he was trading. Like, it is easy to find many trades in these lower time frame charts today because the volatility is so, abundant. So if someone sits down and says, I'm aiming for 12.5% a week, none of you right now should aspire to do that like right now. You don't have it. You don't have the experience. You don't have the skill sets. You don't have what you need to know how to do. But I'm introducing it to you now because I promised it would come. And here it is. It's as simple as looking for something like this, just with one PD array. But I strayed off a topic earlier. I said we could do the same idea with any of the PD array. Like this is an old low taking out what? Sell side liquidity. So while this is a 5-minute chart, and this was the hourly chart here as it passes down into the rejection block here, you have this old low here. So even if you weren't looking at this as a rejection block because that's not what you want to use, you already know that below this low is what? Sell side liquidity. And comparing this low to that low with the dollar index or cable, if this is euro, and it's not euro. I'm just suggesting to you that that's the, man, I tell you, this mouse. That low seen here on the 5-minute chart, I don't know why this thing does this, but it's pissing me off. So we have this low, it takes the sell side liquidity out. That's a turtle soup. And then you wait. Does it run back up and take out the high? That's it. That's all you got to do. You could be a buyer on that, yes. You can buy the sell side liquidity on the SMT. Or wait. Use it as, okay, now I know I have a setup forming. Wait until market structure breaks and then come back down and get the order block at the imbalance. Optimal trade entry here, there, boom. Now you can be a buyer and then look for all the down close candles to support price. And pyramid, if that's what you want to do. And nobody will ever come close to you if you know what you're doing, if you know how to engage, and you know where the market's drawing to, and you're building in positions like this. Man, well, you've watched me. You've seen what I've done with demo accounts doing it. It's unmatched. You can't keep up with that. And it was all done with lower time frame entries, not daily, all 1 and 5-minute setups that repeat multiple times a day, over and over and over again. You just got to know the ones that are highest in terms of probability. And how do you know that? By experience, tape reading, paper trading, demo trading. That's how you get there. That's the order. That's where you go through it. That's why I tell you, yeah, it's going to take you 18 months to get extremely good. Can you be profitable in less time? Yes, absolutely. You can get profitable before 18 months. But to be proficient, to know what you know, and nobody's going to tell you what you've been able to acquire in terms of your understanding and knowledge, and that experience can't be stripped away no matter how many times they insult you. That's around 18 months. That's the fair horizon that everybody should focus on when they first start with me. But I've had students that come in here in a couple months say, you know what, I've cracked this thing for myself. I know what I'm looking for, and they're profitable. What does that mean? Does that mean you are inferior as a student? No, it just means that they had more experience and something clicked in their mind and it helped them. Everybody, the results are going to vary, folks. No matter what you do, whether it be me teaching you, somebody else teaching you, Larry Williams teaching you, the results are going to vary. But how you train yourself and the submission to the process, that has to be the same for everybody. And then your unique personality is going to creep in, as it should. And you let that steer you into the model and approach that you want to trade. A lot of you don't want to do lower time frame. Okay, it's fine. You can win Robin's Cup type of contest without trading intraday. You can short-term trade. There's nothing wrong with that. You're just not going to have a whole lot of setups, and your frequency will be lower. But look at the highest one right now. A gentleman from Italy, ran real quick up into first place, and he's smartly just sitting still because he knows the guys below him aren't going to try to break their necks to come out of their seat. And he's got like 405%. So 405% with a couple weeks left. He's got it. He's won it. And congratulations to him. But that's like the highest that we've seen in Forex division. So if you start, like for instance, as a side project, okay, none of you in here that are new 2021 group members, okay, none of you should try to go into Robin's Cup next year. You don't know enough yet. Okay. Even if you think you do, please just don't do it. And to prove that you don't, start a demo account with whatever amount at the beginning of the year on January 1st, if that's how you want to do it. I wouldn't start trading until February, but whatever. Say you start a demo account, a brand new one in January, and try to do what you think you would be doing in the Robbins Cup trading with live money and see how you fare at the end of the year. Okay. I think that would be an interesting thing to see what each of you would do. Collectively, everybody. Just see what you can do with it. And have that as the idea that this was how I would trade if I was competitively trading. You're not trying to trade a lot. That's not what competition trading is. It's trading well. It's not over leveraging and abusing risk and leverage. It's trading well. Okay? It's not about how much you have per se, because I've seen a lot of people. In fact, last year, another Italian guy came out of nowhere and just ran really fast up. Fell short just below 1,000%. And I told my son, I said, he's gaining so much each day. And when he loses, he's losing like 50% or close to 50%. So he's like full bore maximum margin call is his stop loss. And that's how I used to trade as a commodity trader back in 1993. You don't survive with that. And sure enough, when he got to 900%, he's thinking, I got to get to 1,000% minimum. And then he never returned back to 900s. And it was like 4 more days of updating, and then he was off the leaderboard and never showed up again. And that was unfortunate, because if he just would have sat still, which is, I even put it on, if I'm not mistaken, I was on my community tab cheering him on. I was like, just stay still. Don't do anything. Nobody's going to be able to come up where you're at. And he would have won. But greed and, competitiveness, I guess, has kicked in, and thinking, well, I'm going to keep doing it. In competitions, you don't want to do that. Especially like Robbins. Robbins is, unless you really are going after Larry Williams, which is huge. Like, that's a huge feat to be aiming for. And you need the full year, really, to do that, because you're going to have periods of drawdown. You're going to have to sit through certain months of the year where it isn't clean price action. And then on top of it, we have all this other stuff like COVID and garbage is going on. Who knows what next year is going to bring? So you have to be careful and navigate all that stuff. But if you look at the average of all of the rates of return in Robbins, they're not that bad. They're respectful returns. Don't get me wrong. There's nothing bad about any of them. But I am convinced that every single one of you could do better than those results. I'm not saying Larry Williams, okay, so that we're fair. But can you do 300-400% in a year using my concepts? I believe that's possible. I personally believe that's possible. You might not be able to do it, but I believe it's possible. Everybody should be able to have that faith in themselves to be able to do it. I have faith that the concepts can do better than that in the good hands of someone that's experienced and versed and has impeccable self-control and risk management. But in the hands of someone that's reckless, my best concepts will still fail in their hands, because they're going to try to use a hammer as a screwdriver and vice versa. And that's it. It's over. So does that mean the concepts fail and aren't effective? No, it just means that person that tried to use them failed. And there's nothing wrong inherently about that. It's just unfortunate, because if you go out there and you say, hey, I'm going to be doing this and this and this, you don't talk about it. You just do it. Just simply do it. And I know a few of my students said they're going for it next year. And I think that's awesome. I hope they place, and I hope they don't do more than it's necessary. And I would be very pleased and proud to see them do that. Understand, I'm not encouraging you to do that. I'm not suggesting that you should do it. Okay? I'm not telling you to do it. But those that have shown an interest in it, they're saying, please don't do it. Please don't join. I'm going to be trying to make an attempt to do. There's other divisions in there. There's the futures division. And there's also the Global Cup. And I think, if I'm not mistaken, I think Global Cup is like June. It starts like in the middle of the year and it runs to, I guess, whatever. I'm not sure the ending date of that. But there's really like, there's three divisions. So it's actually four, isn't it? There's stocks, futures, Forex, and then there's the Global Cup. And whatever, there's room to do whatever needs to be done if people need to see somebody trade. But you don't need to take a lot of trades to build it up when you use things like I'm showing you here. If everything lines up and you're on side and you have the narrative understood and you know what you're looking for in price and you're using impeccable risk management with competitive risk management and money management, you can parlay the balance very, very quickly. But here's the main thing here. If you don't know what you're doing, it can create savage drawdowns if you lose control of yourself, which is why I built it the way I did, where I'm trying to get the maximum juice out of every squeeze, knowing that if I get stopped out, I'll get pinched. But I'm confident that I have so many new setups in a lower time frame that who cares if I have a series of 3 or 4 losing trades. If I'm really going in there hammering it, I know I'm not going to take the maximum loss 4 trades in a row, right? So say the first one I get banged on the maximum loss, 4.5%. Okay, 4.5% comes out of the account. Well, I'm reducing the risk. And I'm going back in with another quote-unquote high probability setup, which shouldn't take me long to find because I'm in the lower time frames. So if I take 50% of that loss I just absorbed in a losing trade, and I make 50% of that back with half the leverage, what am I going to do? I'm going to close that trade right there. And I have completely erased that loss in my mind and freed me up to go back to the 4.5% risk. That's how I use Optimal Math. I literally, as soon as I get that loss back in terms of 50% of it, say, let's make a simple so we understand one another. Say I take $1,000 loss, okay? I'm not saying 4.5% is exactly for a figure of 1,000, but let's make it monetary so we understand what I'm saying. Say the loss equates to $1,000, okay? And I drop down my leverage to half of what I used to absorb that losing trade of $1,000. Once I make a new trade with half the leverage I used when I took the loss of 1,000, if I make $500 in the next trade with half the leverage, as soon as I get that $500 back, I'm closing the trade right there. Because I want to get right back in the seat of maximum 4.5%, because it won't take me much to get the balance of the 50% that I absorbed as a loss. In other words, I lost 1,000, then I risk half and make $500 back. Okay, now I'm closing that trade to $500. And the very next trade I'm taking, I'm going to be at 4.5% leverage again. So I won't need as much movement to get that balance of $500 still to get back to pre-drawdown. You see what I'm saying? So by doing that, that's how I go full bore, but I'm not going nuts like Larry Williams did. Like Larry Williams, let's be honest, that dude had bowling balls in his pants in 1987. Like, that's a lot of heavy-handed trading and just letting it go, letting it just rip. Whatever happens, happens. And man, I would have thrown up multiple times, looking at what he was doing in those statements. But you don't need to do it that way. Now, I know some of you are saying, well, if it's so easy, why don't you go out there and do it? Well, that's my intention. That's exactly how I intend to do it. I'm telling you the recipe on how I'm going to do it. I'm not hiding it. You paid to know how my mind thinks, right? Well, I'm telling you how to do it. Just how I'm going to do it. That's the approach I'm going to use. And I don't see anybody that historically has ever entered that contest that's going to ever be able to keep up with this. And you don't even need the full year. Like, it's like 6 months. And you literally get to what he did in a year. Think about it. Do the math. No matter what balance you start with, it's the percentage return. You go in the Forex division, or I'm speaking hypothetically. I'm not promising that you're going to be able to do this, okay? And I might get in there. When I ever decide to go after him and his return, I stated that when he passes, and he's old now, he's not a spring chicken anymore. When he passes away and he's no longer with us, my intentions are to do that. Now, if some Yahoo makes it to the leaderboard this year coming or any other year in the future and gets the number one and says, hey, ICT, come knock me off, well, you'll see me do it sooner. So it's always been that way. That's always what I've asked for. And if it happens, and then great, it happens. But you don't need the full year. And that's why everybody I've ever talked to about this, I said, look, everybody says, oh, I ain't going to devote a full year. Listen, you don't need a full year to do it. You just need that setting. If we're going to do a competition, and it's going to be in a setting where no one can be faking anything, audited, it's sponsored by the CFTC, the exchanges know about it. Listen, like, you can't ask for any better stage than that. So all the talkers, all the big shots out there, listen, I did not enter that thing in 2020. I did not enter it in 2019. I did not enter it in 2018. How many times do I got to say this? I didn't do it. So bottom line is this. If you want to be competitive and you want to take what you're learning here and ratchet it up to Olympic level results, any PD array that you use as your model, okay, like I just talked about tonight with the rejection block, if that is your model, and if that's your PD array of choice that you like seeing it, you understand it, it's turtle soup, the logic is behind it with the SMT divergence supporting the narrative, and you wait for the break in the market structure here on the lower time frame charts, you have a complete model right there. That's it. Because you have to understand up here, somewhere up here, I don't know what it would be, that would be the draw that you align yourself with, saying, okay, I believe that the market's going to draw up to that point up here. So you submit to that each time it makes a new pullback into a discount array, which is as simple as a fair value gap, a bullish order block, could be a new sell stop run for a smaller time frame turtle soup. And you just keep parlaying it in there. And that's it. That's how you build it up. And you let the equity behind your latest entry in your pyramid support the trade that you just put on. So even if it pulls down against you, okay, now I'll give you one more piece of this. Say you bought 10 lots down here, 10 standards down here on the rejection block. And then it comes up, gives you the break in market structure, comes back down in the bullish order block. And then you do what? You add 8 more. So now you have 18 standard lots. So every pip is now $180. Well, now you have all of the movement from here to here, and the stop would be something in here. So between here and here, you have 10 standards on with profit still. So if this gets stopped out at 8, you have 10 down here. So even if it collapses and runs against you, your 10 lot offsets the loss on the 8. Now, you have your 8 on. I'll tell you this, mouse. When it starts running from your position that you assume, hypothetically, with 8 standard lots here, you have movement of $180 each pip that it moves here. Then it comes back down, gives you another order block here. You enter here. I don't know, say you do 4 lots there. So now you have $40 more per pip from here as it's rallying. And every new stop on the new position, that's what you're watching. Okay? Because I know some of you are thinking, okay, well, what happens if it moves against your new position? If it starts breaking down, if it takes out 1 or 2 of the pyramid entries, I collapse. I don't hold. Because I have all of this down here that's going to offset majority of whatever that would be. So that way it controls what Larry Williams was not protecting himself from. See, Larry didn't have much of a shield He didn't have that kind of protection. He just was like, I believe it's going to do this. I'm going to put everything behind it, and come hell or high water, this is what it is, because I believe even if I take a loss, I can trade out of that, because he was a good money manager. Well, I'm a good trader. I'm technically proficient. And I believe that this is a higher form of money management, and it's still aggressive. Combining those two, that is formidable. Even if it's not me, and any of you learn to do this very well, I'm promising you, folks, there ain't a Yahoo on any social media venue it would ever come close to results in the hands of someone that's proficient with what you're learning here. Like, I'm telling you, it will make you want to be a jerk if you let it. And it was doing that many years for me. And then my closest family and friends were telling me that, look, you gotta change yourself, because you're ugly about doing that. So once in a while, to manage my own ego, that's why I carried on the way I did on Twitter. It was like therapy. But if you allow yourself to learn how to do this properly, practicing your demo account, I guarantee you will see that you don't need a rented MT4 server to run up a demo account like you've seen multiple times. I've done this several times, and in short order. Can you stomach that with live funds? Probably not. Almost definitely not. Because making fast money and big money fast is scary if you've never done it before. Because it's like, well, I mentioned the other day when Bitcoin was collapsing, and I told you I was watching it, and I'm thinking to myself, if I was trading that, like, I would have held on to it thinking it's done. Like, it's going to go down below 20,000. It still might do, but I'm just saying at the time, I would have been willing to hold on to it longer than if it was something like a Forex pair or a futures, where I kind of feel like it's going to stop at reasonable levels and then start to retrace. The way it was dropping a few days ago, that looked like the bottom was falling out of it. And I just don't have the stomach to trade that kind of market. I don't understand it. Okay, and I've said it many times. But fast money is worse than scared money. See, scared money keeps you from taking a new trade. You can't take any more pain. Well, apart from fear of missing out. But that's manageable pain. Losing money, that's pain that cuts deep. So scared money is less painful than fast money. That's a weird kind of pain to be in, because you're in a trade, and if you do this long enough, you're going to have this experience, and you'll understand it when it happens, because it doesn't make sense when you hear it, if you've never experienced it. But fast money, when the account is parlaying up really, really fast, and you're in trades and the position sizes are enormous, and you've built it up and you pyramid it and it's running, it's painful for you to start thinking, wow, it hit my target way faster than I thought it was going to go, and you don't know what to do. Like, you want to see it go to specific price levels, and you always have like a best case scenario, and that's usually well beyond where I think it's going to go. That's how I do my targeting. If you're in a market that's, you pyramided it up, it's a big position, and it's really running in your favor, and you haven't got to your best case scenario target, but all of your subordinate targets that was beyond the typical, 2-to-1, 3-to-1, like we're in like 5-to-1 and more. If it gets to those levels there really, really fast, that's fast money. And fast money is poison many times, because it's like, oh, what do I do? What do I do? Like, you start thinking, well, my best case scenario target is probably too little. And then you do what? You widen it and you reach really, really far. And then what happens is you turn that trade into a hope and a prayer. You have a winner, but now you've turned that winner into a hope and a prayer. Man, I hope it does double what I just got. And you just completely lost sight of everything. And there's many times I've done that in the 90s. And then watched it completely reverse and collapse. And have a winning trade that was pyramided up turn into a losing trade. 1993, 1994, 1995. Those years, I experienced that. And it sucks. It sucks bad. Because at the time, you feel like you got the Midas touch. You feel like everything you're doing is just going to be golden. You're Pony Boy. Everything is gold. That's an Outsiders reference if you've never read the book. But fast money is scary because it changes everything. It completely blinds you and it makes you think you have a lottery winning ticket. And you do while you're sitting there in profit. And one of the funniest things, and I said this when I was on Baby Pips, I learned it from Larry Williams. One of the surest ways that you should get out of your trade is as soon as you grab your calculator and you're saying, okay, I have this many contracts on and I'm in profit here. If it goes to this, as soon as you start thinking that you need to do that, get out of the trade. And I'm going to tell you something. That actually served me very, very well. Because that, he calls it the King Kong feeling, like you feel like you can do anything. That's right about the time where 90% of my trades, when I was in profit as a commodity trader back in the early 90s, that's exactly when the highest form of profitability in every trade I was in that was profitable. And initially, they were hit and miss. Like they were once in a while here, once in a while there. And then when I got a series of running luck, even in those periods of luck, the times that I felt like I figured it all out, I cracked the code, and I knew everything I'm going to need to know. I'm going to be rich in a couple of years, that type of feeling. Every single time I pulled out my calculator at that moment, and I'm telling you, it wasn't much longer after that very moment that the trades would reverse, and every single one of them became losing trades. That sucks. It sucks. And if you've ever traded with live money, you have experienced that. I know you have. Everybody has done it. And it's a truism in the marketplace because it's a psychological barrier. Fast money poisons and pollutes your perspective. It's like it blinds you. You lose all reasonable thought. It's like, all right, well, we're drunk, so let's just roll with it. And you just end up becoming a losing trader. So there's a lot of balancing act. And I guess the way you avoid doing it and combat that is you have to have very rigid exit strategies. Like you're reaching for your objective and that's it. Once you get it, you're gone, done. Go back in the next session, same day. And there it is. You just keep building up on it. And don't fear the losing trade because the losing trade is just a transaction. It's the same thing as a new trade entered underneath the dealer spread. That's a losing trade. Every single trade opens up as a losing trade. Every single one of them. You have to trade your way out of it. So when you take a loss, a hard stop getting hit, that's just like a dealer spread on a larger position that you're in, but you just got to go back in and recoup it. It's just transactional cost. It's just like getting a flat tire. It's like going to the doctors. Nobody wants to do it, but when it happens, you got to pay for it, right? And as long as you have that rationale going into it, and the lower time frames are going to keep spitting out new setups on a high frequency basis, they're going to keep delivering. Okay, so you're not dependent on these higher time frame setups that take days or a week to reform something new. The lower time frames offer you many, many setups But skill and experience and tape reading is going to be able to tell you which one of those setups on a lower time frame is the one that you should be engaging in. And this is just one way of using one of the PD arrays, the rejection block, as a framework, and how to use it and build a model around the entire PD array. It's not simple when you try to find that, in the core content. But when I do a lesson like this and I bring it to just the bare Chrome, no bells and whistles, no COT, no extra this, no extra that, you have to have very simple logic of what you're looking for. And this is what I mean. When you know what you're looking for and you understand your model, it can be written on the back of a business card. There's a lot of moving parts that you need to understand that wouldn't necessarily be written out and spelled out on the back of that business card. But the general principle and approach to your trading model could literally be written on the back of a business card, like I just outlined here. Like, this is a complete model. This right here, what I just explained tonight, that's a complete model. And I even talked about and lectured on how you can supercharge it with things like Optimal F and pyramiding, and how to manage losing and having a shield, and how even while pyramiding, a losing trade wouldn't collapse you entirely and crush you. So you got a lot. Like this lesson here, it's worth the monthly payment. And they get better than this. Like, you have a lot of things that you're going to learn and be introduced to. And they're all intended to inspire you to dig deeper in yourself and in price action. You're going to find something that's going to resonate with you. This might not resonate with you personally. You might be intrigued with the pyramiding examples, okay? Or you might be looking at this saying, okay, I see what he's saying about the rejection block, but I wouldn't look at that one. I can see this optimal trade entry here, and then I can understand everything that he said about that. And instead of doing the 10 standard lot down here, if I can get the mouse shut right down here, I'm going to do it on this optimal trade entry here. So I'm going to use a 10 lot there and go in 8 here, 4 here, and let it run. So I know some of you are thinking that, and that's good. That means you're learning and you're acquiring the experience to know that, well, while this isn't necessarily my cup of tea, using the rejection block and entering down here because that's scary, because I won't trust it. Okay, that's fine. The break in market structure, you all trust that. And you have the backdrop and underpinnings of the rejection block with the SMT divergence that would frame your underlying reason or the catalyst for looking to be long. Then you wait for entry patterns. This is the selection or catalyst to set you in a buyer's model or buy program. So when you're in a buy program, now you're just going to wait for your entry pattern. But you have to have a reason to be a buyer or a seller. And once you have that, once it's in the market and an order flow gets in sync with your narrative and your bias and where the draw on liquidity is, something up here, whatever that would be, relative equal highs, an old high, old low, an imbalance of some kind, a bearish order block, a bearish breaker. There's many PD arrays that are premium, whatever that would be to frame that logic that you're reaching for. It's got to match your personal perspective and personality. And if you do that and you submit to that, you won't second guess your model. You won't second guess your approach. You won't have any doubts about what it is you're learning here. And you won't worry about, well, I know I can do well with this, but I see this guy or this gal in the forum and they're saying they're using this model and I want to try that out too. Don't. Refine something that's already showing you evidence that it's working for you. You have to bloom where you're planted. And if you try to stray and do other things before you're really good at one thing, it's the same as system hopping. And it prolongs the time that's needed for you to be successful. And you don't want to prolong that process. I'm not saying you want to shorten it to unrealistic, but you don't want to add more time that would be a natural learning curve by dabbling here and dabbling there. So wherever you feel led initially, as you go through the core content and your lessons and whatever you start gravitating towards, what PD array, what style of trading, like are you a day trader? Are you a scalper? Are you a short-term trader, swing trader, position trader? Are you a futures trader? Are you going to be interested in trading the indices and not so much on Forex? There's nothing wrong with that. That's how I teach. I want you as the trader to say, you know what? I can use this in an asset class that I feel more comfortable with. I don't like Forex, or I don't like trading bonds, or I don't like trading stock. I don't like trading crypto. Not that I push that here, but you know what I'm saying. I've had a lot of people come out of crypto. They came here wanting to do very, very well in crypto, and they moved out of crypto. Now they're into futures. So think about that. So there's always that transition phase that you have to be willing to, number one, identify and say, you know what? I'm going to investigate that approach to doing this. And you might be pleasantly surprised that that's the very thing that you're meant to do. And once you get it, no one's going to talk you out of it. No one's going to be able to say, oh, well, I got something better. You're going to laugh at them because what you have works. It matches your personal style. It matches your personality. You know it works. You know it repeats. You know what you're looking for. And you don't care if you don't have a setup today because you know it's going to eventually give it to you tomorrow or the following day. They repeat over and over and over again. And that is comfort. And it's very encouraging. And I can't articulate that in any more stronger words because once you experience it, you'll know what I mean. Okay. And it sounds fanciful. It sounds lofty, like, oh, you know, whatever. It happens to everybody if they stay with it long enough. And sometimes it happens for folks in here a lot sooner than they thought it would. And unfortunately, when people state that when they become charter members, yeah, I found my model, blah, blah, blah. Those that haven't found it, they're not quick to say congratulations. They will take it as either they're lying about what they're saying they, acquired a model that fits them, or they turn it around and they look in the mirror and say, you're dumb, you're not going to learn this, and you're wasting your time because you should have learned it because you've been here 2 years or 1 year or 3 years longer than this guy or girl. That's toxic thinking. So you have to avoid. That's why I tell you when you're journaling not to put negative annotations or remarks in your journal because you're feeding your subconscious negativity and it's going to lean on that. And everything about trading or models or development, you're going to have a laundry list of examples of where you have logged toxic experience. And that's not how you learn. You can't poison yourself with negative thinking. And it's not in trading alone, it's in everything. So I've given you a ton tonight on this very, very short video. So you know what happens every single time I state it's going to be a short video. You better pause the video there, go get some road snacks and some drinks because you're probably going to need it. It's not as long as I've done in the past on other ones, but I just let myself go tonight. I just wanted to be generous with everything I was referring to and give you some more things to get your gears turning. I promised, like I said, I would mention competitive leveraging and how to pyramid and all that business and how we would incorporate those types of things in the lessons you're learning. Contrast that with just trying to take a trade down here and saying, okay, I'm going to put 10 lots on and hope I get to up here and taking partials out. There's no comparison. And I saw a member, and I'm going to close on this point here. I saw a member in the charter member area on one of the user groups, and they stated, I see ICT talks about doing partials, and he also talks about how trades ideally on the higher end should be 5-1. But if you take partials off, you're not really getting 5-1. That's true. But while you're learning, the goal is to look for 5-1 framework. You're not going to find consistently 5-1 if you're new. You're going to believe that 5-1 is in that trade without experience and learn over time doing it multiple times over and over and over again. And eventually you'll get better at picking framework that is 5-1. But because I teach partials, I'm teaching you, number one, to reward yourself when price allows you the opportunity to take something off. That is encouragement. It's like going through a martial art. There's different colored belts, okay? And it's really unfortunate because it's needed in America. A lot of the traditional martial arts don't have that. That's an Americanization of martial arts. So when you have these little graduated increases in your progress and the results, you measure that by what you take in and collect. And that's the bottom line, right? Like you want to see the bottom line of your demo account increasing over time. I train you to fund these demo trades by taking partials. I teach you that. So that way, your majority of the time, you're going to be wrong when you're first learning. And that's in everything. No one really knows what they're doing when they first start, okay? And you're floundering and whatever. But by teaching you how to take partials early on, and if it offers you 10 pips, take something off. If it offers you another 10 pips, now you got 20 in, take something off. So now you have 30 pips spread across the two partials. Over time, you will learn to take less partials off because you've seen enough of the framework that leads to 5-1. And then you submit to that saying, okay, I don't need to take the partials off now. I'm going to graduate into doing effective stop loss management and lock in something. And if it takes me out, I'm okay with it because I've seen enough times now. I have enough experience now that these trades repeat. And I don't need this very one to pan out to 5-1 and still do well. So it's a graduated transition from trying to do the framework of 1-1, 2-1, 3-1, and then aim for 5-1, but you're not going to get 5-1 every time you try to go for it while you're learning, because you don't even understand what 5-1 is right now. I guarantee you, if I did a poll on the 2021 group, the last group in mentorship, if I asked them in a poll, can they do a 5-1 gearing on a trade? And majority of, if they're honest, they probably would say no. And that's reasonable because they don't know how to do it. But over time, doing this graduated transition from 1-1 risk to reward, 1-2 risk to reward, 1-3. That's why I'm telling you need months, up to 18 months. Because you just can't watch a video, listen to logic, and say, yeah, I know how to go out and find 5-1 now. You have no idea what that looks like as a new trader or new student, really. You can't understand it conceptually. What makes that? And what makes it not likely? That's the main thing. How do you avoid setups and not fall victim to thinking, oh yeah, this is going to pay out 5-1? Because that's retail mindset. They think it's going to go 50-1. If you watch all these guys on YouTube, they're always doing 20 to 50 to 1 leverage or risk to reward. If they were doing that, they'd be billionaires in a year. But, that's sound logic, and most people don't have that. But if you take partials off in the beginning, it rewards you while you're learning. Okay, it's like that little belt system they use in martial arts in America. Over time, you're going to get better at knowing, I don't need to take a partial off here. It looks strong that it's going to go to that level here. And I'm just going to move my stop up and lock in a portion and let it run towards 3-1. Now, you framed it on a 5-1, maybe it delivers, maybe it doesn't. But you let it go to 3-1. Then you lock in 3-1 because now it's running beyond that. And say it fails getting to 5-1. So you risked, $100 to make $500. But it goes to $400 and then comes back and hits your stop at 300. So you bank 300. You didn't get your $500 or 5-1. Are you going to feel bad about that? No. Some of you will feel like, it didn't go to my target and obsess about that. Instead of saying, I did really good. I managed this right. And I took 3-1 out of the trade. I wanted 5-1, but it only gave me 3-1. And you didn't take any partials. That's graduated transition to 5-1. Eventually, you'll get to the point where you're not taking any partials unless you're in high volatility days where, it's just better to get paid because you don't know what's going to happen. Or if you're in conditions that might be a day where you can get a market reversal profile and you have a trade on and you're doing really well, then you can do partials there and just be content with that. And if it reverses on you, you've paid yourself. So it's all a matter of experience. So don't think that or read too much into the idea of ICT talks about 5-to-1, but he teaches partials, so that's failed logic, or that doesn't make any sense. No, you're skipping completely over the idea that partials are a training wheel for developing students that are early in their development. Partials are training tools to teach you to take something off. And over time doing it by experience and tape reading, you will see that you're in a trade that's likely to go further and you won't feel inclined to take that partial off. And that transaction and that experience from that transaction will deposit new understanding about yourself, how you interact with the marketplace, and what you have visually retained by that experience being in that trade. And over time, these build on one another, and it eventually gives you the confidence and the know-how that can't be articulated by me or any other teacher. You'll know by experience. Okay? And that's why I like the books Market Wizards, because they talk a lot about experiences and the takeaways from those experiences. They're not teaching you when to get in a trade. They don't even teach you how they trade. They talk about the experiences and what they took away from those experiences and how it impacted them. That's the same way I teach. I give you very simple things to do in the beginning that graduate into more technically required thought processes and more analytical thoughts and decision making. And sometimes that's a little intimidating and it causes people to throw in the towel and say, okay, this is getting too complicated. When it's not complicated, they just don't submit themselves to the process, which is important, because if you do that and you do it enough time, you'll get the results you're looking for. But if you quit, it always ends in failure that way. But you have to press into that. And everybody that's found success in my concepts have failed a lot in the beginning, but just kept plowing at it, just doing it over and over and over again, and not accepting that as the final result. Like you can't say, I'm done after this. You got to say, okay, what did I learn from that? And now I'm going to learn not to do that very thing again. And that's what partials help you tolerate. It gives you that little reward, okay, that yellow belt from a white belt, or a green belt from a yellow belt, or whatever the belt system colors would be in that quote unquote martial arts in America. So as you're gravitating and moving towards being a black belt, risking $1 to make $5, or 1 to 5 gearing for your trades, while you aspire to that, and that is black belt grade trades, and that's the only style of trade you're looking to take a trade on, anything less than 5-to-1, you're not doing it. Okay, that's your black belt idea. But nobody walks into a dojo and puts a black belt on that first day. They don't do it in a couple months either. It takes them a while to get there. So you have to reward the student to keep them engaged. So that's why I teach partials. That's why I tell folks that it's good for you to do it. Take it off, because you'll see that even if you do that and you fail with the rest of the trade and stops you out, it's adding to your bottom line. That's the point of doing all this, right? You want the demo account to grow. That proves the conceptual ideas work. The transaction gives you a measurable result. It may not be the result that you want every single time, but it will hopefully be doing the thing that's positive more times than it does the negative. And the only way you can do that early on, when you really don't know what you're doing, is if it moves in your favor, 10, 20, 30 pips, you take something off. And that's your partial. Yes, if you're going to compare that with 5-to-1 initial idea about the trade, no, it isn't 5-to-1 that you've taken out of the trade. But you're ignoring the entire logic as to why I teach partials, because it's meant for developing students to reward themselves for modular experience and understanding. Okay, so that's going to be it for tonight. Hopefully I've done very well in terms of inspiring you, opening your eyes up to other things, and obviously showing you what you can do with the rejection block. Next Wednesday, I think we will talk about reclaimed order blocks. So that'll be Wednesday's midweek lecture teaching. And then the following Wednesday, I don't know what that'll be. So I'll tell you whatever that one will be in next Wednesday's discussion. Tomorrow, I don't know what I'm going to do. I don't know if we're going to be doing anything with tape reading. I have a son staying with me that doesn't normally live here. So he's spending a night again tonight. So we may do something tomorrow that prevents me from doing any live recordings or tape reading. But if he sleeps in or whatever, that might give me the opportunity to do something tomorrow morning during the New York session. So I don't know. It might be just a regular commentary, or it might be something in addition. So we'll see what we get in that regard. Until I talk to you tomorrow, be safe.